Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So just yesterday, I was sitting down and kind of watching an old Warren Buffett interview. An interview he did alongside his longtime partner in the insurance businesses at Berkshire Hathaway, that being Ajit Jain. And it was basically a Q&A session with some students from when he went and visited India. And he got some really interesting questions from that group. Many of them are questions he's had a million times over the years. But a couple of the questions and answers he gave around investing through volatility really resonated with me. So I want to talk a little bit about that in this video. How do we go about investing through big stock market dips, when the stock market goes up a lot? How do we kind of think about investing through that and trying to stay rational and take advantage of those big fluctuations as well? So that's what I want to talk about today. Just before we get into that, you'll see that I no longer have the moustache. So Movember is now complete. I'm filming this on the 1st of December, and I have to say a massive thank you to everyone who contributed to that cause in November. So the final number raised was about 1,940 New Zealand dollars, which was far in excess of the $1,000 target initially set. So that money's all going towards a great cause, and I appreciate that very much. But for that said, let's get into the video and talk about how Warren Buffett thinks about investing through volatile stock markets. Now, the first thing I should say is this interview was done with Warren Buffett actually several years ago, but it is just as important as ever today, and particularly in India, actually. So I'm going to put up a chart here that shows the Indian small cap index, and you'll see that this has been quite volatile over a period of time. India has one of the quickest growing economies on the planet right now. It's got a long runway for continued growth, yet we're seeing a very volatile stock market. I think there's a lot of people getting into Indian stocks for the first time, some of those being Indian locals and some of those being people investing from overseas, and it's been very volatile. One of the people that was spoken about a bunch on the channel over the past month is Monish Prabrai. He started investing in India more heavily in sort of 2016, 2017. He started out with a great run in many of those stocks, and a lot of those stocks have come down a lot since he first made his investment and made some initial gains over the first year or so. So it's been a very volatile market. So I think a lot of the advice that Buffett gave in his answer to some of these Indian students' questions is really just as important as it has ever been. And if you want to actually see Buffett himself answering these questions, I'll leave a short clip at the end of this video, and I will also leave a link down in the description below if you want to check out that full sort of Indian Q&A session with Buffett as well. Now, Warren Buffett basically tried to get across two core ideas throughout this Q&A session, particularly when it related to volatility. So he said that a good investment analyst should be able to do basically two things. The first thing they should be able to do is value a business, and that is the core idea that has driven Warren Buffett's entire investment career, is trying to understand what a business is worth. And if we tie that into the idea of a volatile stock market, what you can have happen is you can have a business that's worth X, and in Buffett's words, it can, fluctuate very quickly between selling at 1.5 times X down to 0.5 times X, and you can see a lot of fluctuations kind of in and around that intrinsic value. Now, the core idea here, if you want to be a good investment analyst and a good investor and make great returns, is to really understand what X is. That is your core job as an investor, particularly if you're someone that has a value investing focus, Warren Buffett style, is to try and understand what is this business fundamentally worth, and then the market fluctuations shouldn't bother you. They should actually be something that encourages you to make even more money. So if you understand that a business is worth X, or worth, say $100 a share, give or take maybe 10% either side, because intrinsic value calculations are inherently just an estimate, and there are certainly things that can change that valuation over time. But if you understand what that business is fundamentally worth, and then you have wild fluctuations in stock price in and around that number, it creates a lot of opportunity for the rational long-term investor. Not necessarily people that are looking to make quick money, looking to make money over the next year or the next quarter even, but people that are willing to accumulate shares in businesses over a long period of time, high quality businesses, and sort of build a portfolio. The more volatile the stock market and the more rational you can be, and the more you can understand what X is, or what the value of the business is, the more opportunity you have to produce really good long-term returns. It means that when stocks are volatile, you've put yourself in a position to where you can take advantage of those price changes. So if the prices do drop down a lot below what you think the business is worth, you have an opportunity to buy and accumulate shares really aggressively. And if in a very, very short space of time that price can then go up a lot, you now have the opportunity to sell out of those positions if they get to above intrinsic value. And that's basically what a lot of value investors try to do. They try to buy something for maybe half of what it's worth over maybe 3 to 5 years. They sort of expect that is then going to get priced in and around what it actually is worth. And if that happens over 3 years, they'll get a double in 3 years, which is sort of the mid 20% a year compounded rate of return. If it happens in 5 years, that's about a 15% rate of return. If it happens in 10 years, that's only about a 7% rate of return. So if you're in really volatile stock markets where those fluctuations can happen quite dramatically, and potentially you can get an undervalued business more often than you can in a more stable market, and then it goes back up to intrinsic value more quickly than it does in a stable market, you can potentially have that double happen maybe in a year or in 2 years, in which case your rate of return will just keep going up and up and up because it's taking a shorter space of time for that business to go from, say, half of what it's worth up to its full intrinsic value. And you're getting these opportunities far more frequently if stocks move around a lot more. Now, it should be said that this is not the traditional approach to how people think about volatility or think about risk. Now, from an academic perspective, basically people see volatility and risk as exactly the same thing. They have this metric called beta, and beta basically measures how much a stock moves around relative to an index. So if you take a US stock, they're typically compared against something like an S&P 500. If an S&P 500 goes up, say, 1% in a day, and a stock also goes up 1% in a day, that is a beta of 1. If the stock goes up a lot more than 1% generally, or if the S&P is down and that stock goes down more than the S&P generally, that will tend to have a higher beta attributed to it. And basically, the way that academics tend to look at beta is that the higher that number, the higher the risk, because it's more volatile and moves around a lot, and the less money they will tend to put towards those highly volatile stocks if they don't have a large risk appetite. Now, that is not at all the way that value investors or Warren Buffett or Charlie Munger or any of these people think about risk. Now, the way that they think about risk is basically permanent loss of capital. If you invest $1,000 into a business and you never get $1,000 back, that is risk. That is what they consider the worst possible outcome for making an investment. They don't particularly care if the stock moves around a lot. Like I said, it creates potentially some really good opportunities if you're rational and if you can understand what a business is worth. And in fact, they view price and valuation basically the entire driver for risk. So if you can, again, buy a business for a lot less than it's worth, they consider that a lower risk investment than had you have paid the full price for that business. Because let's say you buy into Apple, and Apple, if you run an intrinsic value calculation, you think it's going to grow, say, 10% a year out into the future, and you think that Apple is priced in and around intrinsic value right now. I'm not saying it is or it isn't, but let's just say that's kind of the opinion that you come up with. Now, if you buy into Apple at exactly its intrinsic value, then in order for you to get, say, an 8 or 10% return or whatever sort of discount rate you used in your intrinsic value analysis, again, if you don't know what I'm talking about, feel free to check out my intrinsic value videos. Now, what basically happens is if Apple doesn't execute on that 10% growth rate, let's say they only grow at 5%, that is going to reduce your rate of return. If they grow at 15%, that's going to increase your rate of return. And you're quite dependent on sort of the underlying performance of the business. Now, if you can actually go out and buy shares in Apple for, say, half of what it's worth, and for that price to actually be the intrinsic value, which you don't think it is, but if that price was genuinely the intrinsic value, that would imply a growth rate in future for Apple of maybe 0% or negative 5%. Then that is a lot lower risk proposition if you expect that Apple is going to grow at a faster rate than 0 or negative 5. In other words, the lower the price that you can pay for a business relative to its intrinsic value, the less reliant you are on the business results, the less spectacular those results have to be. And vice versa, if you pay a really high price for a company well above its intrinsic value, then you're basically betting on that business growing at a much faster rate and producing much greater cash flows than perhaps is realistic for that particular company. And if they can't achieve those growth rates, or they can't hit those cash flows, or whatever it might be, then you're putting yourself at a much higher likelihood of having those permanent losses of capital. So those are my thoughts on Warren Buffett's advice on investing through volatile stock markets. Basically, his thoughts are that as long as you know what the value of the business is and you focus on that, the more volatility, the better in terms of producing really good returns. But a couple of things you have to know. You've got to know what the business is worth. You've got to have a really good handle on that. That is going to drive your investment decisions right through those volatile periods, and you have to stay intensely rational. You can't make decisions because you think the market might be about to go up or down or sideways or whatever it is. You have to buy on sort of a price to intrinsic value kind of basis. So hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one.
Question from the back row, the red, yes.
Samriddhi Gupta from St. Stephen's College. So the Indian markets have been very volatile in the past. You're a long-term investor. So given the present scenario, do you suggest foreign investments in the Indian economy?
Volatility is the friend of the... I love volatility. If no stock ever moved around very much, it'd be impossible to make any real money. Volatility is your friend. You can turn it into your enemy. I mean, if you get worried when your stocks go down, or you feel like you ought to rush in and buy things because they've gone up, volatility is your enemy. But if volatility means that a very good company someday will sell at X, and sometime later it'll sell at 2/3 of X, and another time it'll sell at 1.5 times X, you will get very rich if you can just keep figuring out what X is. And volatility is what will enable you to make a lot of money. So anytime people get upset about volatility, they don't really understand the nature of markets and how they should be thinking about them. The more volatile the market, the more money we'll make at Berkshire.